All right, everybody. Gordo and Gary, Modcast, episode number 5. Hey, if you like what we're talking about, go on, like it on YouTube, subscribe on all your favorite podcast listening systems. Although this is the Modcast, it's not a podcast. Hey, Gary, how you doing?
Great, Gordo. How are you?
I'm fantastic. You know, I don't know how many consecutive weeks in a row we have traveled together, but it's a bunch. And we've had some fun along the way.
I know we traveled together early this week, and it already feels like so long ago that I was going to say, but I haven't seen you this week. But we were actually together on Monday and Tuesday.
Yeah,
we're recording this on a Thursday for
hours ago at this point. Yeah. But I've been completely confused because we traveled early Monday morning, and I've thought when I got back it was Thursday and it was Tuesday. So
right, exactly.
Yeah. Hey, everybody. On our last episode, we discussed M&A over the last 25 years in our space. Like what has happened in the RIA space in mergers and acquisitions land over the last 25 years. If you didn't get a chance to listen to episode number 4, go do it. And it's a little bit of fun. I don't know. We had fun. But
I enjoyed it.
Yeah, you enjoyed it. Right. Yeah. I know other people enjoyed it. They've told me so. All right, so episode number 5, today's topic is the mergers and acquisition space today. So last episode was all about the last 25 years. Today, we're going to unpack our learnings from what's happening right now in the RIA space. And, there's a ton of research out there from a lot of bankers that are helping RIAs prep their business, get ready, and then go to market. Building those CIMs or confidential information memorandum, and packaging you up, building the PowerPoint on your firm and what it looks like, and your P&L and your people and your clients and what you do for them, all that stuff. So there's a lot of research by those people in our industry, and we're gonna share some of it today. I think it's really good stats. So we're going to talk about that. We're going to talk about, buyers and sellers today. We'll talk about when to sell and why, the private equity markets and their money and, how has that helped the RIA community. We'll talk about investment banking around the space. We'll talk about your clients, your employees, your firm, what happens. And we'll get into a whole bunch of other stuff, but that's kind of the agenda for today. Does that sound fair?
Sounds fair to me. Yeah.
Okay. Well, good, because you helped us write it.
I helped create it, so yeah. That sounds awesome.
All right, so let's just rip the Band-Aid off really quickly. In 2014, when I sold my RIA, remember I had a partner, and we transacted in 2014. There were that year 41 known transactions.
In the RIA space.
41 known transactions, 40 others than when I joined you and Mike.
Right.
So let's just kind of go back in time a little bit. 2020. How many were there in 2020?
A lot more than 41, but fewer than today. I'd say 150-ish.
So just 6 years later, right? 14 to 20. We went from 41 to 159 RIA transactions.
So almost about 4 times.
And that's really, 2018, we clipped 100. 2019, we got to 130. And by the way, this is all from the DeVoe Q1 deal book research. So we like to thank our friends at DeVoe for putting this research out, and we're readers of it. And that's where we're getting these stats. So then, again, we eclipsed 118, 130 in 19, 159 in 20. So Gary, what from 20 we had 159 deals. I'm showing you on the screen.
Yeah, I have a little cheat code here.
Yeah, a little cheat code. And in 2024, what happened in RIA deal land?
272 mergers and acquisitions in 2024.
10 years post my transaction, right? So 41 and 14, 272 and 24, just a decade later. And it's just been a ramp of activity.
So that's almost 7x the volume in 10 years. It's incredible.
It's amazing. And so we're recording this in the second quarter of 25. But in the first quarter, we, as an industry, set an all-time quarterly record of deal volume with 75 transactions in Q1. Prior to this Q1 of 22 was the highest, and that was 68. So we're on pace right now to do over 300 transactions as an industry in the RIA space this year. It's crazy.
Yeah. So last year, 2024 was the biggest year recorded in RIA M&A activity, and this year's are already on pace to be bigger. And that 75 in the first quarter of this year, not to geek out too much on the math, but if you're listening, I mean, you might be a financial planner, you might be a CFA, you might be another kind of math nerd of some kind. So you might appreciate it. So, 75 in the first quarter of 2025, we're going back using 2014 as a benchmark year when Gordo sold his business. There were 41 in all of 2014. So almost double in the first quarter of 25, the number of transactions that there were in the entire year of 2014.
It's crazy.
It's crazy. And so I think we're going to talk a little bit about today, like who are all these people? Why are there so many sellers and why are there so many buyers and transactions going on? And I'll just note too that maybe it's a lead in to where we're going. It was a small enough marketplace in 2014. And, obviously I was at United Capital at the time. You sold your business to United Capital. I don't remember the exact number of acquisitions we made at United Capital in 2014, but it was probably somewhere in, 4, 5, 6, acquisitions, which means that if we did 6, we were 15% of that 41. And we probably could have named, 3 or 4 other firms that were most of the other 85%. And, it might have been like 70 or 80% or a handful of firms that were making acquisitions on a regular basis, what people called aggregators. And then the remainder were probably like transactions between or maybe local RIAs, right? Which was the pattern before there were more nationally focused or regionally focused firms. And obviously the landscape today is completely different.
Well, and this doesn't even tell the whole story. If you kind of go back to what you were just talking about. For example, we did 8 in 2024 as a firm, Modern Wealth did. We acquired 8 practices, but only 7 of those got reported because they were pure RIA. The 8th they were operating like an RIA, but they were an independent broker. They were on an independent broker dealer platform with their own entity underneath it. And so they looked and felt a lot like an RIA, but it was a lift out from a big broker dealer that everybody would know.
Yeah. And if you go, Google, M&A report, wealth management, RIA, it just depends how people are defining their data set, if you will, the sample size. But all of the trends are the same, no matter if they're using broader wealth management or RIA only. All of the curves look exactly the same.
Yeah, and I think it's probably double the actual volume of consolidation going on when you consider those IBD lift outs and those teams that are joining. All right, so one thing I often get asked is, wow, the market is just on fire. Like, RIAs are receiving outbound communication from firms like ours all the time, right? Whether it be daily or weekly or monthly, it's just a red hot space. And what I get asked is, how much longer could this go on? And what I'll share is, I'll share this. For every firm that comes off the market, there's more coming on the market in that they're establishing a new firm, right? New firms are being established at a higher clip than firms are coming off the market. So if we do 300 transactions, there's something like 450 new firms that will start in 2025. So the industry's the RIA space is actually getting larger, even though there's been all of this consolidation over the last 15 or so years. It's, you break away from IBD,
That's right.
Break away from Wall Street.
There are more new
break
RIAs
away from RIA.
Formed. Right. There are more new RIAs being formed than there are changing hands.
Right.
So the supply keeps getting replenished. And I mean, you can look around and see different numbers, but I looked up recently how many individual RIA firms are there, registered firms in the US. And, one source said 17,000, one said 16,000. Let's say it's 17,000. So in the last 4 years, which are the big years where things really jumped up, there have been about 1,000 transactions, but there's still 16,000 that haven't transacted. And, there were some that transacted earlier, but there could be repeat depending upon, who does what. And there could be, big firms swallowing up medium-sized firms. I mean, that could be one of the future trends as well. So, so I guess the answer is, as I said in episode 4, for those of you who listened to it, I made a comment about how people have always used sort of an analogy around like what inning of a baseball game are we in terms of like the maturation of the RIA space and the transactional elements of the RIA space. And I've said like people have been saying we're in the bottom of the third for like 10 years, but maybe if we're in the bottom, it's a really long. I mean, these pitchers can't get anybody out. It's incredible. Batted around 17 times. But we might be in the bottom of the third, in which cases we got a long way to go.
Yeah. The other thing, we spend a lot of time working with, some of them call themselves M&A consultants. Some of them, say they're sell side bankers. They're investment bankers or people that are hired by firms to market their firm to people like us, right? Hey, I think I'm getting ready to be done here, or I'm looking for something that I don't want to build internally to join, right? I want to join something, or I want to build something, but I don't want to do that internally. Or I'm kind of getting towards the end of my run and I want to make sure my clients are well cared for. Whatever the reason is, there's a whole industry of people out there that are helping RIAs find people like us to join. So we're going to do a little trivia. Okay. And I'm going to ask you a couple questions. So I have 6 reasons why. This is all per the DeVoe Q1 growth report. Actually, this is his 24 report that shows the 6 reasons. So in 2024, he surveyed the industry and they gave 6 reasons as to why they may have wanted to choose a new partner or sell their firm. What do you think the number one reason RIAs joined firms like ours was last year? And by the way, Gary has not had a sneak peek at any of this stuff.
I don't have this up in front of me. I know what I think the real answer is, but I know what I think people said.
What do you think they said?
I think they said growth.
Okay, they said growth. And what do you think?
Is that right?
Well, hang on. What do you think they really sold for? Like why?
Succession.
Okay.
Planning.
So those are...
Which could mean a lot of different things because a lot of the people selling are not retiring.
Yeah.
Nobody who's joined us, for example, is retired.
Right.
But one thing, I don't want to break your flow, but what are the, like, when we look at like, well, why are there so many sellers? Just go back and look at what is the average age of an advisor in the United States.
Yeah.
Which is, I think, somewhere in the late 50s.
All right. So hang on. Your number one guess is growth or succession.
Yeah.
Okay. You got number 3 and number 1 is to the reasons.
Okay. Which one was number 3?
Number 3 was succession.
Okay.
So ding, ding, ding. Gary was right. The number 1 reason was growth. All right. So growth. We're going to go through all 6 real quick, and then we'll come back to growth because I think that's a big topic that we should cover. And 65% of those surveyed said that was their number 1 reason. 49% said succession, by the way.
And growth meaning they are looking for a partner that can help them grow more than they can on their own.
That's right.
Yep.
That's right. So we're going to come back to that one because I think that's a massive topic.
Yeah.
And it's probably one we should do a whole episode around is, what does growth mean and why is it important? All All right. So number 2. So growth is number 1. Succession number 3. Number 2. What do you think it is?
No, I think I was going to say we did episode 2 and 3 were about organic growth.
Organic growth, correct. Yeah. But I think we could do a whole growth episode on inorganic growth and why that matters for firms like us.
Yeah.
Why inorganic and organic strategy tied together is super powerful, and what does that look like? There's a whole nother, trust me, there's a whole nother show. There's 100 more shows on growth.
Yeah.
All right. So number 1, growth. Number 3, succession. What's number 2?
Number 2 is getting cool swag from their buyer, their new partner.
Yeah, swag, stuff we all get.
Stuff we all get. Yeah, like this.
Yeah, right. I've got mine on. You've got yours on. I've got it demoed on the wall here.
I think the swag trade is massively underreported.
Yeah, unfortunately, I think that was number 7 on our item of 6 reasons why.
So close.
It was so close.
Okay, so number 1 is growth, a partner who can help me grow. Number 3 is a succession plan.
Yeah.
Number 2, there's so many reasons why people do join firms like ours.
You're very involved in this step, by the way, as a hint. You're very involved. You have what we call the football.
De-risk, money.
Liquidity.
Well, it's funny because I was thinking that was what would be sort of in code in a succession plan. Succession plan might be code for
get me paid,
get money, take some money off of the table and some risk off the table. Okay. So liquidity, personal liquidity is number 2.
Yeah. So right. So Gary, on the day you join, Gary gets the football out with all the codes and figures out how to wire the money. Right. So that's why I'm saying he was quite involved in this step. So growth, liquidity, succession. Okay. All right.
I would say 2 and 3 are very tied together, but succession
they can be. Although you do have partners that are, hey, I've tried to hire a G2 advisor. It hasn't worked for me. Yeah. I just need to plug into a firm, and I want my clients to be well cared for. And I'm kind of running out of steam here. I need somebody to come in and take care of my clients, my life's work.
Well, right? Look, number two in this case, liquidity for sellers is a huge driver of all of this, and a very good reason for people to transact. Because I mean, if the typical advisor is, I don't know what the current age is, 57, 58, it might be the average. It was 56.
Older than us, by the way.
It was 56 a year ago when I wrote about it, so I assume it's almost a year older, because there's not a ton of young people coming in, although there are more young people coming in now, certainly at our firm. If you've been building a business over 25 to 35 years, most of these people are earning a pretty good living, certainly compared to the average person. And, most of them are planners or investment advisors or both. So should have done pretty well over time with the money they've made, but there's no guarantee of that. But, you've been building up value for a long time. You want to make sure that your family is well taken care of, live the life you want to live, et cetera, et cetera. The great thing about this space is you have a lot of options to take some risk off the table, create some liquidity for yourself, but not stop doing what you love. And in fact, do more of what you love by joining a partner. This is not meant to just be an ad for us, but partners like us where, okay, guess what? We have a chief compliance officer. We have a head of HR. We have a head of accounting and finance. All these things that you end up either having to do or manage when you really got into business because you loved working with people. You loved, maybe you loved solving complex problems for them or just guiding them to a better life. You spend some time doing that, but you don't spend all your time doing that once you've built a business. And so partners like us and many others let you do that. So yeah, liquidity makes sense.
Succession. All right. So just as a reminder here, we're in the February 25 annual RIA M&A Outlook from DeVoe and Company. They are the ones that published this through a survey. So 1, growth, 2, liquidity, 3, succession. Number 4, this was something that when we sat down and we said, what do we want to do differently? What are we going to do that's not just financial planning and investment management with a really nice, consistent story over the top of that? What else were we going to do?
Well, I assume the answer is a little broader than one thing, but access to more solutions and services for
You were very
clients.
close because you used the word broader, which is the first word in this answer.
Is it? Okay.
Yeah.
Broader set of services or solutions
Perfect.
for my
Nailed it.
clients.
Broader set of services. Scale.
Yeah.
Right? Like, I'm just an independent advisor, and although I go to COIs and I ask attorneys for referrals and I give them referrals, and I go to CPAs and I ask referrals and I give them referrals, and I quarterback the relationship, and I'm working with the attorney, I'm working with the CPA, I'm working with the banker. We know that that's how RIAs think they grow, is through referral. But what we know, because we witness this all the time, the integration of a CPA/tax team in the financial planning engagement accelerates prospect activity from prospect to client status. We know that it deepens the relationship. We know that they bring more to us. They refer their friends and family. They increase additional wallet share. They take advantage of the estate planning offering. They take advantage of the risk offering, right? We're delivering more and more services to the client. We've had, I will say, not fee compression over the last 6, 7, 8 years, but we've had service expansion creep. So you're doing a lot more for the dollar that you're charging.
You do
And that
more.
broader set of services is something that a lot of RIAs are out there asking about and looking for. How do I solution this in my firm? So that's number 4, broader set of services. All right, I'm going to give you 5, because now we're getting into some of the.
I like this guessing. If you give me a hint.
Okay, I'll let you guess. Okay, yeah, this is
real. This is real, folks.
This is for sure.
I don't have this in front of me.
Okay.
Nor have I read it. Sorry,
Yeah.
Dave. I haven't.
Right. He read it months ago, though, Dave.
Yeah, maybe. Yeah. I mean, I love these reports, but I don't memorize them.
Yeah. So growth, liquidity, succession, broader set of services. Those are the top 4. Number 5.
Okay. Yes.
What is it, Gare?
I need just like a little hint. I mean, give me like a little game show hint here, like not just.
Well, you've got to, talk yourself through it. We've got growth, we got liquidity, we got succession, we have services.
Opportunities for my team members, my employees.
No, nobody wants that. No, I'm teasing. Everybody, actually, it's very high on most people's list.
I would think so.
Yeah. Succession might fall in the succession bucket a little bit, but not the way we think about it.
Yeah.
No, not broader opportunity for the team.
Just a little hint.
Yeah.
You're like, how do I give you a hint without just saying the words? Go ahead, just say what it is.
No, it's it's back office support.
Oh, of course.
Yeah, you were going to be challenged with that one. Sure.
I mean, that makes sense.
So that's number 5. Number 6. So back office support. What is that? It's client account opening. It's money movement. It's
right.
Being the technologist. It's being the chief compliance officer. It's having a marketing team. It's it's all those things that Gary mentioned a little bit ago on why you got into the business to serve clients and solve problems for clients, and then you end up wearing a whole bunch of hats, right? And it's really getting support to all that stuff.
Yeah.
All right. Number 6 is you're going to have to unpack this one. Functional support.
Functional support.
I think that's really like compliance and marketing. And
yeah. And I this is one, let's assume that they mean there are functions that I currently have to do that I want support for, which I talked about a few minutes ago. Like, when you're the founder or co-founder and advisor, you're wearing so many hats. And the funny thing is, in the hundreds and hundreds and hundreds of conversations we've had over the years, that is way higher than either number 5 or number 6. Whether 5 or 6 is that, like, I think if the question were asked a little bit differently, we don't know what the survey was, but I think that, like, getting back to doing what I love if you asked our like individual advisors who were in the process of selling, like, what are you most excited about? And you put, liquidity, succession plan, getting back to doing what I love. Like, there's no way getting back to doing what I love would be less than number 3. And it might even be for some people number 1 or number 2 more than success, because they might not really be that close to succession. So I would suggest that it's really a lot higher on the list than where it's showing up here.
Yeah. Well, those are the top 6 per the survey, right? And there's a big nugget in here. And I was with Dave last week, actually, at an event.
You sure it wasn't this week?
What's that?
You sure it wasn't this week? No,
it may have been. I don't know. The people that office with me here in Monterey, I think they'd forgotten what I look like, but I was with him and he went over some of the findings here. And one interesting nugget in this report that he put out in February: Next Gen Affordability Index. Can future leaders buy out RIA founders?
No.
The question is the next gen of your RIA able to buy out the founders? And in the survey, in the 2024 survey, and again, I don't know how many respondents there were. I'm sure it's in here somewhere in a footnote, but you should go look at that. You should read the reports, chock full of just tons of information. Last year, owners believe that 20% of Next Gen could afford to buy their firm. Just 20% of the people in the office, the advisors in the office, would have the financial strength, pardon me, to either go out, put cash down, or go to one of the lenders in the space. There's been a couple of great ones enter the space in the last decade.
Yeah.
That will help you, with debt to borrow the, money. So your cash plus some debt plus, a first position, lean position on the business. 20% of Next Gen advisors can afford to buy the business.
Yeah.
That's really a big reason as to why these transactions are taking place, right? We've actually acquired a number of businesses where the junior talent had equity in the business. They were owners, right? Like not just 1 or 2, 3%, but large chunks of ownership were had by the Next Gen. And these businesses have become worth so much money.
Yeah.
And these businesses are getting so complex that joining a firm like ours or other people like us is really the solution, right? Because the affordability cap has just become a massive challenge for the RIA community.
Right.
And that's what's attracted PE money to the space.
Well, it's the result of it. I mean, it's a circle, but the affordability gap exists because higher valuations are being paid than they were back in that 2014 timeframe.
Yeah, I wish I would have transacted this year instead of that year. But
if you'd hung on, you would have seen a very different price for.
Well, I had a very different life then too.
Right.
Like my life is unfolded in ways I couldn't have imagined because of that transaction.
You made the right move in every respect, but there wasn't a difference between or there wasn't a meaningful difference between what buyers like us back in that day at that point were paying and what what a local RIA would sell for to another local RIA, or G1 letting G2 buy the firm back over with a 5-year note,
or 10,
basically,
or whatever.
Paying them with their cash flow. But the valuations have gone up a lot because, this is the chicken and egg question. Has the money entered the space because smart investors realized, hey, these properties are really valuable, and so it's worth paying more than what people have been paying before. And now there's a pretty clear-cut marketplace today, and it's pretty transparent what people are buying and selling for the most part. But so a lot more money entering the space because there's an opportunity, and the ultimate valuations can be higher if you create scale, i.e. bigger firms are worth more than smaller firms. But it kind of goes both ways, which is, that the pricing being higher is what is driving the volume because people are going, okay, well, it's worth a lot of money. Maybe I should do something. Because there's a lot of advisors who, if you transport them back 20 years, but they were at the same stage of life, it wouldn't have been that compelling. It would have been like, I'd rather just, keep all my cash flow. Cause usually you are selling some of your cash flow, right? Like you are,
Yeah.
like a lot of it. That's
Yeah.
what's creating the purchase price.
That's what buyers are buying.
Yeah. So when the multiples were much smaller, it was like, well, it's just a couple of years of income. Yeah, it's capital gains versus ordinary income. So there's some value there, but it wasn't as big of a gap between, it's not just like what other people will pay for it. It's also like what you're actually earning versus what you're getting in a lump sum. But now that gap is huge. And the older you are, the more it makes sense to say, well, if someone's going to give me, many, many years of cash flow, mostly upfront or over 2 or 3 years, some in cash, some in equity, that makes it more sense to me financially than just continuing to earn it, paying taxes on it every year. And the great part is, you don't want to retire? Great. Keep working, keep doing. And again, reduce some of your activities in the areas you don't love and focus on the things you do love. So, but it wouldn't be possible without the money entering the space, and the money, and it's a virtuous circle. If you view it as positive, it's a vicious circle. If you view it as negative, we obviously view it as positive. I think sellers, if you're owning and operating an RIA, it's a great time to be alive.
Yeah.
Because you have a lot of options and you have a property that's worth a lot.
Well, like you said, I think it was episode number 3. It's the RIA neighborhood's a pretty good neighborhood to live in.
Right.
Right. It's a pretty damn good neighborhood to live in. Look, we're going to get into like private equity and why that's good for the industry on a future episode. We deeply believe that it's great for the industry, and we're touching on a couple of the reasons right now. We're not going to get into this today. We're not going to unpack all this today, but look, your firm is worth a heck of a lot more money today because of private equity's interest in our industry.
And the important thing to note, I mean, so we've talked a little bit about this. We've talked about the sellers and what are the motivations to sell, what are the motivations to seek a transaction, their top 6 reasons. There's a lot more transactions. The other side of those transactions are the buyers. And the other thing is there's a lot more buyers. And again, most of them, maybe not all, but most of the people you'll see on those top acquirer tables have outside investment, usually private equity, maybe some other source. Now we have
mostly
sovereign
private equity.
You have sovereign wealth funds coming into the space. Yeah, I mean, and many private equity firms. I don't know exactly how many currently have an investment in the RIA space, but I don't know, it's dozens.
So this is depending on who you believe in the industry. There's somewhere around 77 PE firms that have made one or multiple investments in the RIA space today.
Great.
There's supposedly another 40 to 50 who are looking for an opportunity to back.
Yeah.
So there's just a lot of money coming into the space right now. And again, we're going to get into that, all the reasons why in a future episode, but they love how durable the business is. Right. They love how consistent the revenues are. They love that we get paid 7 days a week, that it's all recurring. There's a whole bunch of reasons why.
But again, it's the circle of life. There's more sellers because there's more buyers who are willing to pay a price that is very attractive and interesting to the sellers. And there's more buyers because it's a space that investors love for a lot of great reasons. It's, which we haven't really talked about, but I mean, the investment thesis is always something like, there's big waves of the RIA space itself is growing. More people are becoming RIAs. There's more assets coming to RIAs.
Well, so just stop on that for a minute. That means they're getting bigger. The average firm is no longer $100 or $200 million. I mean, they're getting big.
Right. The average transaction size, I don't know if you can find it in the report, but I'm sure that if we looked at the average, and they may not have it, but the average transaction size in 2024 in terms of the AUM of the underlying RIAs, I'm sure was a lot smaller than the average transaction size in 2014 versus 2024. Firms are getting bigger. Some of it's 10 years of market appreciation helps. So even if you didn't add a single client or lose a single client, you would have grown. But everyone added and lost, and there's a mix. But the but the fact that we have just like this, I know I used the word ecosystem a few episodes ago of people who are at an age that planning for retirement, even if they're not ready to retire, makes a lot of sense. So succession and liquidity, prices that are attractive, but you don't actually have to move out of your house. You just have a co-owner of your house. Unlike real estate, where if you sell it, you have to go somewhere else to live. You don't have to go somewhere else to live if you sell your firm. You're just part of, you might have a different name on the door. And investors, buyers who view it as a super attractive space because it's recurring revenue, it's growing, it's a high retention loyalty rate, and lots of opportunities to continue to expand and consolidate. All those things are creating this perfect positive storm of those charts that show that every year there's more and more transactions.
It's all getting bigger. So I did find it, actually. The average seller AUM, so these are transactions that were, the seller managed 100 million to 5 billion. 5 billion. So 100 million to 5 billion. That's got to be 95% of the transactions out there. In 2019, the average was 747 million. And in 2025 year to date, it's 1.167 million per the DeVoe report.
Billion.
$1.167 billion.
Yeah. Which means back in 2014, it was probably, the average was probably 250 million or so.
Yeah, or smaller.
Yeah. I mean, it was rare to see firms that were in the $500 million plus range. It really was.
Yeah. So like if you take the number of firms that are RIAs today, that's one methodology to see if we have a growing industry.
Yeah.
The other is the size has gotten I mean, it's just staggering how much growth there has been on the average RIA over that decade. It's crazy.
Yep.
So again, we'll get into PE and what they love and why, but look, your firms are worth more money. Your teams have better career opportunities because of private equity, and clients have better services and outcomes available to them because of private equity bringing capital to the industry and making our firms more professional, and again, extending services, pushing additional services out to the client. So we'll get into a whole bunch more reasons why private equity loves the space, but those are just a few quick hitter things that are valuable to you and important to you and why you should like their entry into our industry. Again, firm more money or is worth more money. Your people have better career advancement opportunities, and clients have more service and outcome opportunity available to them. All right, so let's talk really quickly. So we've mentioned DeVoe. There's a whole bunch of firms out there, and it's seemingly more and more all the time, kind of like buyers, who are interested in being what they call a sell-side advisor or an investment banker or an M&A consultant. And again, DeVoe's one, Alaris is one, Hugh Partners is another one. Gladstone is certainly in the industry, and they've been productive. Houlihan Lokey's in the in the industry.
Right.
And again, a whole bunch more. What's that?
Many people knew the Park Sutton business, which is now Houlihan Lokey.
Yeah. Park Sutton was acquired and then ultimately turned into Houlihan Lokey. So you have, again, Houlihan Lokey, you have DeVoe, you have Gladstone, you have Alaris, you have Hugh. There's a whole industry out there.
And many more. And we can't name.
We won't list
everyone.
them all, but there's a bunch of them. And, but we named some of the most active in the space, or the most active in the space. And I think my view is it's great to have someone like that in your corner. And what I say is, the let's just call them bankers for now. The banker, their job is to, number one, understand your business very, very well, build that SIM that we talked about, that confidential information memorandum, and put in your financials and your people and who your clients are, not by name, but like who is your typical client that you serve? What are the services you provide? What are the fees you charge? Why is your business interesting? Why should we be interested in the business? And all those interesting critical facts. But more importantly than that, they know who would be a good cultural fit. They knew whose business model would be a good fit with your business. And they know who has the ability to perform, right? They know who can execute once they put them in front of you, and you get to know them, and you sign a letter of intent at some point. But more importantly than all that, I believe their role and their responsibility is to be what I would say Jiminy Cricket on the seller's shoulder and on our shoulder, right? Like the truth teller in the middle. And they're telling you, the RIA owner, the founder, the CEO, the executive team, you're asking for things that are not rational. That's not in market, quote unquote. That's not how it works. And they're telling us things like, these are the things that are most important, and these are the solutions that you need to bring, or the problems that you need to solve in order for both firms to have a good match, right? They play a critical role in the industry. We enjoy when they're involved. We've certainly done we brought on plenty of firms that weren't represented by an investment banker, but those are the benefits of working with one, right? Would you add anything to that?
I mean, you went on for a while, so I just kind of zoned out there.
Oh my gosh.
Most of the
I'm in a zone now.
I think that it's all part of the professionalization of the space. And it's gotten more and more so. And I think that, there's more bankers. They're obviously competing with one another, just like all the buyers are competing with one another, and the sellers, if they're in the same markets, are competing with one another. And probably getting better at what they do all the time to stay relevant and competitive. But I think a good banker can add a lot of value to the process.
A good one. There are some dreadful ones out there.
Yeah. I mean, in terms of like from the buy side, just what you get presented in like, and if you're looking to sell, I would ask for, show me an example of a SIM, and SIM again is the term Gordo described before, confidential information memorandum. We may have joked about this earlier. Why, when confidential has a hard C, is it SIM, which is a soft C? I don't know, but it's just what everyone calls it. So you could ask your banker. The things
we talk about.
Two things. Why is it called a SIM? And two, let me see a sample one of a firm you've sold, and see how they are presenting you. How are they going to present you? And I'll be honest, I don't know how many of the sellers really go through the SIMs, because sometimes you'll meet with people and like the stuff you're reading about them, they don't entirely seem to know. But
sometimes there's surprise.
Yeah.
Shock.
Like, what? We do that?
Yeah. What do you mean? What?
Yeah. And, but it matters a lot in terms of understanding the business, and particularly if you as a seller care, that you wind up with not just a good financial fit, but a good cultural fit, which is a whole other conversation. We're already well into this podcast, so we'll have to save that for another day.
We talked a little bit about that when you were zoned out.
Okay.
All right. Pardon me. So we are going to wrap this one, and I'm going to preview the next one. 10 reasons we said yes, a buyer's perspective. Yeah, guess what? We're going to do one that's the 10 reasons we said no as well.
Yeah.
And I think that one would be very interesting. But the yeses, follow along, understand what's interesting to us, and what turns us on and what turns us off as a potential partner. And I think it's probably going to be pretty consistent from firm to firm like ours, that those 10 reasons you said yes or 10 reasons you said no, they're going to be very consistent.
Yeah, there's some differences.
Of course, there's a buyer for every business. But we're going to get into that next time. So I'm Gordo, that's Gary, and this is episode number 5, the mergers and acquisitions space today. Again, go on, share on all your favorite podcast platforms. This is a Modcast. We'll come back at you very soon. Have a great day.
And come find us at modcast.show.
I forgot that again. Modcast.show. Is that right?
I think so.
Yeah, well, that's what it is now.
Paul will tell us.
See ya.
Thanks, everyone.